So then there is sales, right? So we haven't seen much of that in the last year or so. But I think with lower interest rates, we should start seeing some exits, and say you've had a property that has increased in value so the basis is higher. Talk to me about the tax ramifications for just a normal person in a single deal.
Yeah. So normal person in a single deal, the property's gone up in value. When you sell that property, you have a capital gain. If you've held the property, long term, that would be a long-term capital gain, taxed at preferable rates. And usually you would say, okay, if I made $100,000, then 23.8, a percentage of that would be taxed at the capital gain rates. What actually will happen is if you've had depreciation taken on the property previously, um, to the extent that you have that $100,000 gain, if maybe 20,000 has been depreciated, then you have $20,000 of that 100,000 is ordinary income, and the remaining 80,000 will be taxed at capital gains rates. So something people don't often realize will happen is that you do have that depreciation recapture at the time of sale. The good thing is if you do have those passive losses carrying forward, those are going to free up to cancel out the tax event that you would have.
So how do you calculate that? So say I put in $50,000 investment, and then say I got 30,000 in losses. What is my basis? Like, what is my investment in year one? Is it 20,000? Is it 50,000? And then how do you calculate capital gains from that?
Yeah, so if you have a $50,000 initial property, you took $30,000 in depreciation, your basis is now $20,000. So it's your basis and the amount that you'll use to calculate that gain is going to be what you bought the property for less the depreciation that's been taken. So if you're selling something, just to use some different numbers, if you're selling something for $150,000, now you have $130,000 of gain
And then
to be recognized.
that 130 will be at capital gains, which is rough long-term capital gains, assuming you've held the investment for more than a year, which will be roughly plus or minus 20%-ish in
Yeah,
taxes.
so of that 130,
Hmm.
30 of it will be considered ordinary income because the gain is coming from recapturing that depreciation, and
Mm-hmm.
then the remaining 100,000 will be capital gain.
And then the 20 will be just return of your original investment.
Hmm.
Okay.
Exactly.
So to kind of think about it, so 20 return of your original investment. The next 30 is depreciation recapture, which will let's dig into that in a second. And then the additional 100,000 will be long-term capital gains. Is that right? Yeah. And
Exactly.
then for the long-term capital gains, there isn't really much you can do to kind of offset that, right? There is uh like actually, just keep that an open-ended question. Is there anything you can do to defer that?
It depends on your tax situation. You
Mhm.
might have, if you have long-term capital losses from securities or other investments, those might be available to offset your long-term capital gains now that you have capital gains. Right now, before this exit, all of your all of your like income or losses every year were in that like passive activity bucket. And now, if you think of all your income as you have like ordinary income, passive income, now we've also opened another bucket for capital gains. So now you're bringing in capital gains, and just like passive income and passive losses can offset each other, capital losses and capital gains can now offset each other. So that's one avenue that you have.
What
Okay.
what is in that? avenue of like, is that tax loss harvesting? Like, what is in
Yeah, essentially.
opportunity zones? Like, talk to me. Let's talk about the capital gains and then the depreciation recapture and how I can pay zero in taxes.
Okay. So capital gains you can offset with existing losses that you have carrying forward. You can harvest losses. That would be selling other investments that you're holding at a loss in order to offset that gain that you've just realized. What that'll essentially do is you'll be able to reduce the amount that you would be taxed on that gain by the amount of loss that you're realizing somewhere else. Um, Another option is you can reinvest those gains in other tax advantaged investments. So, an opportunity zone is an example of that, where if within 180 days you reinvest your gains into a specific type of investment, you can defer and sometimes eliminate the tax on that gain, similar to a 1031 exchange, but a different type of reinvestment. Um, and then you can also leverage, it's almost, some people call it like a lazy 1031 exchange, where you leverage, so you have this income and these gains that are happening from this one investment. You can also, all of your passive losses are going to get freed up. Um, if you have any, those will be available to offset your ordinary income. And you can leverage and making a new investment where you have those losses, um, where you have like those first year losses, and use those to also benefit from and offset that gain that you're just recognizing.
Could we double click on the freeing up passive losses? Because I have like $500,000 worth of passive losses that I haven't used.
Yeah.
So
So
talk to me about, yeah, what does freeing up?
Okay. So again, like thinking about the buckets throughout
Hmm.
the life of the investment, you have passive losses can only offset passive income, and that's a rule that you need to follow. Then in the year that you exit the investment, new opportunities arise. So now in this year that I'm disposing of my investment, all of those passive losses, they're no longer limited to offsetting other passive losses. They can now offset all ordinary. They free up as ordinary income, and I can take passive losses from any of my investments up to the extent of the gain that I'm recognizing. So, to give you two examples of that, if I have $500,000 of passive losses, and my deal didn't, things didn't go that well, my gain ends up being only 200,000. The entire 500,000 is freed up as an ordinary loss. So I've offset 100% of my $200,000 gain. And now I have $300,000 that's going to offset my W-2 income, my ordinary income from my medical practice, or any type of income that I have. Granted, I did have a bad investment that brought me there, but the result is that I'm getting, I'm offsetting passive income, and now I've gone all the way and I'm offsetting that W-2 income as well.
Okay,
Um,
I'm gonna have to definitely dig in a little bit deeper. Um, okay, so on that example that you did, what is that multiple deals of the 500? Because mine is like over like 20 deals.
Okay,
And then,
so
yeah,
a
what?
single deal, that would be the single deal had the $500,000 loss. In a second example,
Mm-hmm.
where maybe you have the same, that single deal has $100,000 loss and you have a $200,000 gain on that deal.
Mm-hmm.
So when you exit that deal, the $100,000 loss frees up, offsets that $200,000 gain, and now 100,000 of losses from all your other deals can come in to offset up to $200. You can't go past the $200,000 unless it's from that single investment. But you can use your other investments to offset up to the amount of your gain on the single investment.
Got it. So your first example is good if you have a deal that doesn't do well, and we'll talk about loss of capital again after this. But the second example is where maybe it doubled. You put in an investment of I don't know, maybe like 150. You got $100,000 in losses, and then there's some left over, or there's excess gain more than your losses. And so up until the gain, you're able to use your losses. But at that point, you just want to use your losses against your gain. There's no real benefit to taking those losses and using it elsewhere because otherwise you're going to be paying uh, taxes on your gain, right?
Mm-hmm.
It's kind of just moving water around. Like it's even though you can use it elsewhere, you might as well use it on your real estate gain. Does that sound right?
Yeah.